Hi, thank you for staying to the bitter end. I will try to be brief, and I'll even attempt on occasion to be funny so that you have a reason to stay awake. I'm going to try in this next 20 minutes to tell you where we are, where we're going, and how you might invest given the economic backdrop that I present. One good thing, there's been a lot of consistency so far today. Now, these are the numbers that Dr. Portugal mentioned. You can see here that IMF world growth, big recovery underway this year, 4.5% growth. Anything over 4% is pretty good. A little bit of slippage next year, but still not bad. So there is a recovery underway. Unfortunately, for most of us in the developed world, it doesn't feel like it, because this is a bifurcated or split world, where the emerging markets are growing quite quickly, inflation is accelerating, policy is tightening. In the developed world, particularly the US, it's exactly the opposite. Growth is slow, inflation is low, and policy is loose. And that isn't going to change anytime soon. So in one area of the world, you've got a completely different set of circumstances from the other. And you've got to take that into account when making investment decisions. Now, as Dr. Portugal mentioned, this is a recovery that's fragile. It's fragile because the risks are skewed to the downside. And I'm just going to talk very briefly about three of these risks: Chinese policy mistake, European debt crisis, and the situation in the United States. And see, what happened in China is that they really turned policy on a dime in 2008 because they realized that the world was slowing down. You can see they doubled their rate of money supply growth very quickly, but they were so successful in engineering a robust recovery that they've had to turn the other direction. And you can see here that that has had an effect on GDP growth, and the market has got a little alarmed by it. But I want to stress there is a tremendous commitment to rapid economic growth in China. Roughly speaking, the Chinese authorities feel very comfortable with a 9% growth rate, which generates approximately 9 million new jobs every year. Can you imagine that? 9 million new jobs every year. Well, they have 5 million new graduates every year. So really startling numbers. So I don't think you need to worry about a policy mistake in China. Look at the way in which they can turn policy on a dime. Right? There are very few filibusters in Beijing. Now, European debt crisis. First of all, I don't think it's another subprime. Now, I've been wrong before, but I don't think it's another subprime. One, it's smaller. These are some of the numbers that we're looking at. That basically the IMF in its financial stability review suggests that the total losses associated with subprime will come out at something north of $3 trillion. Sticky number. They haven't been entirely consistent with that, but something in excess of 3. I would say, assuming a 25% haircut on the debt of the 4 countries that are most under scrutiny, then I think we're looking at something an order of magnitude smaller. Secondly, this whole crisis is much less opaque. The subprime crisis, you had CDSs tracking CDOs full of ABSs. These are government bonds, right? And third, leverage is not an issue. There might be a smidge of leverage in Greece, thanks to Goldman Sachs, but I don't think there's too much. So we're not going to have the same problem with the repos leading to forced sales into bad markets. So basically, the good news is it's smaller. The second news is I don't think that they would make any sense for a country to just go through a unilateral sovereign default. The only countries that are really sense for them to default is if you are running a primary balance on your budget. And guess what? None of them are. In other words, the spending exceeds the tax revenues, even excluding the interest payments. And so if you stopped, if you unilaterally defaulted and you no longer paid your interest, you'd still have a shortfall on the rest of your spending, which would create a problem. I don't think anybody's going to default. Interestingly, I just mentioned this in passing, the one country that could default is Italy, based upon its primary deficit, which is very, very small. And the last piece of good news is that I don't think the Eurozone is threatened in the near term. I think it might be in the long run, but in the near term, there's no mechanism for kicking these weak countries out. It doesn't make a whole hell of a lot of sense for them to leave. Just, you can imagine what would happen if they did leave. Their legacy currency, they go back to the legacy currency, that would devalue versus the euro. You'd have big mismatches between assets and liabilities on the banking sheets. So it would just be a pretty mess. I think in the long term, and I don't want to, beyond our time frame here, the Eurozone as it's currently configured is flawed. You cannot, in my humble opinion, have a monetary currency union without tighter fiscal union. And I think that if you're going to have to make a choice between whether you want a looser monetary currency union or a tighter fiscal one, I believe, in the longer term. The threat really comes from the idea that the strong countries might want out in the long run. But clearly this problem isn't solved. It's come on the radar scope very quickly. People are pointing fingers at the Germans for saying, hey, the bondholders are going to have to take some pain in the future, and that's focused market attention on it. But basically, this problem wasn't going away anyway. Of course, you're now getting contagion. The last I heard, we're talking about spreads widening for Italy, spreads widening for Spain, spreads widening for Belgium, and so on. I don't believe in this time frame that this crisis will can basically derail the global recovery. It can disrupt it. It's disrupting markets. But I don't think at this stage it will derail the global recovery. So we're left with saying, don't worry about China, worry about Europe, but we don't think it's big enough to really fundamentally derail things. So let's look at the last problem, the US. And I think some of this has been mentioned before. And really what's happened in the US is that we got an initial kick from inventories. Okay, so this is the way in which the inventory dynamic works. This is by Jacques Tati impression. Production and employment are all lined up. Demand and production are all lined up. Suddenly demand drops, production goes way down, not only to line up with a new level of demand, but also to get rid of the unwanted inventories that build. Once you've got those things, once you've got the unwanted inventories gone, production bounces back up. Watch. There's the production bounce. That's what drove the early stage of the US recovery. It can only do so much. It's now gone away. And so what usually happens is when this guy goes away, consumer spending and housing takes over and drives the next stage. Those are the two. If ever anybody comes up to you in a cocktail party and says, what drives the American economy? It's basically cars and houses. I don't know what kind of cocktail parties you go to, but maybe you get asked that question. And that's what happened to consumer spending. That should be off the chart by now. At this stage of the recovery, that should be off the chart. Look at housing. It hasn't budged. It's flatlined. So the two things, the two sectors that are supposed to take over from inventories and drive the economy forward have just fallen on the face.